Welcome to What's the Risk, hosted by myself, Daniel Crowe, and Peter Mansell, founder of Mansell Financial Group, a financial advice business he founded in 1980. This is a simple video series we hope investors can use to better understand index and portfolio performance, along with addressing some investment questions and dilemmas. This episode is on the MSCI World ex-Australia Quality Index. Some investors would know an ETF that seeks to track the performance of this index as VanEck Qual or QUAL. That ETF sits in the top 10 for AUM in Australian ETFs and was in the top 10 for net fund flows in 2024. So we're probably going to find out why that's the case. Your Investment Philosophy, a book we wrote, shameless plug, available at Amazon. Disclaimer, please pause and read. Suffice to say, our intent is educational and not rendering financial advice. Don't make us tap the sign. These are simple concepts we'd like investors to better understand risk so they can make informed decisions. MSCI quality definition. So the MSCI World ex-Australia Quality Index is based on the MSCI World ex-Australia as its parent index, which includes large and mid-cap stocks across 22 developed markets. So it's 301 stocks drawn from the 1,342 that are in the MSCI World ex-Australia. So how they selected? Index aims to capture the performance of quality growth stocks by identifying stocks with high quality scores based on three main fundamental variables: high return on equity, stable year-over-year earnings growth, and low financial leverage. Robert Novy-Marks is probably the leading academic on profitability, which is often interchanged with quality. He suggested profitability subsumes most of what's going on in quality. Now, Novy-Marks is not a fan of quality. He suggests it's a marketing term and people use quality for a bunch of disparate things, but admits he may be using the battle on terms and labels. But you might be able to add some more context here, Peter, because you've been in several presentations with Robert Novy-Marks. I think you've met him, discussed profitability with him, so you probably add something to this discussion.
Absolutely. I've been fortunate to see Robert present on a number of occasions. I've met him, privately, sat next to him at dinner and talked about his academic work into profitability, and I genuinely would say that he's right to, and it's valid for him to say that profitability and quality, as is defined by others, including in this index, they're actually not the same thing. There are some similarities there, but they're not the same. Profitability is very much about whether the business is operating and literally putting cash in the till from their day-to-day operations. It doesn't necessarily reflect a high return on equity. It doesn't necessarily reflect that they've got low financial leverage, and it doesn't mean that year by year by year in the past, they've had consistently growing earnings. It refers to whether they're profitable right now. So there is quite a difference, but I'll accept that there's some similarities at times. And I believe that profitability as a term should be used for exactly that, and quality shouldn't be interchanged with it in any regular basis.
One final thing I'd say before we move on, index versus active. There's a lot of active decisions being made here for a quote unquote index.
Absolutely. When you're applying three different factors to try to establish what quality is, you're using three different measuring measures, which you would hope are the right ones, and maybe they are, but maybe they're not. So when you multiply the impact of each of those choices together, there's actually quite a lot of human intervention in defining how you're going to assess high return on equity, how you're going to assess stability of earnings, and how you're going to assess what financial leverage is. But then you actually sort of multiply them all together. I would agree. This is anything but a traditional passive index. It's an index where there's a significant amount of human choice being made to make up that index.
And getting into the returns and periodic performance, we've got 30 years here, and I think by anyone's measure, beating the parent index that you draw from by nearly 3.5% per annum over 30 years is reasonably impressive.
It definitely is. If you look at the 1 year results, the 2 year results, they're very similar. You'd pretty much call that noise. The 5 year result, it starts to get a little bit of a divergence, similarly at 10 and 20 and certainly out to 30, to me, this is really a clear indication that you're actually using a factor to slice the market into two components, a quality component, as you've defined to make up the index, and the non-quality component. The bottom row has got both in it. It's worked for that 30 years. Time will tell whether it'll continue to work into the future.
So calendar year returns here, there's no real rigorous analysis, just a simple hunt for a period of underperformance. And in the lead up to the GFC, it lagged MSCI World, but held up better going through the GFC.
When you look at the 4 years in the lead up to the GFC, there was enormous optimism. We'd just come off the back of the second Gulf War and the markets rallied strongly and quality lagged. Investors were much more aggressive, somewhat cavalier even, in the sorts of stocks that they pursued, and quality was effectively left on the shelf. Underperformance, 4 years running, lo and behold, we have the global financial crisis when share markets are very sad and the quality portfolio performs well again. Investors were happier holding quality stocks during the tough times. Other than that, all of the results on that page and the year-on-year results, it's pretty much just noise. You've got one negative result about every 5 years, 4 positive results about every 5 years, back to normal.
And growth of wealth very much underlines what a nearly 3.5% per annum outperformance means over 30 years.
This is a very clear indicator of where an investor imposed a well understood factor on the building of a portfolio and it delivered a great result.
A range of returns.
It's obviously broader in the 1 year numbers than you see from a broader index. The highs are higher. The average is a bit higher. It's a risk-reward story insofar as there's a specific factor being pursued with a fairly well understood risk characteristic attached to it, and the chart looks the way it ought to.
Rolling annual returns, we'll probably get a little bit more on the next slide because it's side by side with the parent index. So we'll just put this up and we'll just roll on to the next one. And as you can see, blue being the parent index, some falls from quality don't seem as deep, while the outperformance in the late 90s and probably more recent years is stronger. So it held up better during COVID, but it's notable that neither saw a negative annual return there.
I think that the telling part of this chart is sort of from the year 2000 through to the year 2010 or 2012. And you can see a really good story there. And that is that in the good times, it doesn't do as well. And in the bad times, it does better. And so you might describe it as a defensive stock portfolio construction for that reason. Some might not like using the phrase defensive stock portfolio, but that period there is fairly telling for me in that the bad's not as bad and the good's not as good.
And chance for positive or negative. One of those charts that with a lot of the lost decade influence was you got more negatives in the 3 year periods and 1 year periods and more negatives in the 5 year periods and 3 year periods.
Truthfully, it's a bit of an anomaly for that to happen, but that is really because of the fact that we're looking at just that specific 30 year period. If we were going back to 1980, I suspect that the chart would look much more traditional.
And largest fall in time and recovery. Reference point here being the parent index, MSCI World ex Australia, was 168 months and negative 48.74. And Cliff Asner says severity is bad, but duration is underrated when it comes to pain. But I think when you're out to these sort of time frames, I don't think an extra 10 months means much because it's pretty much purgatory until you get back to where you are, and the pain becomes probably numbness.
Absolutely. When you look at this, it's all but 12 and a half, 13 years. The parent index is 10 months longer. To me, again, that's just random noise. Minus 45 versus minus 48. Quality didn't fall quite as far, but it's still a pretty ugly fall. I wouldn't be placing too much attention on it.
Risk return or efficient frontier, as it's 300 stocks, maybe you'd expect some more volatility versus 1,300 in the MSCI World, but significantly better return.
Yeah, again, this is the risk return outcome from taking a fairly well understood factor and applying it consistently over what is all but a 30-year period. I think we've seen this globally with value. We've seen it globally with profitability in most markets other than Australia. We've seen it in small caps. This is just another factor. that's utilised in a consistent fashion. It's relatively well understood and it delivers in the long run. At the same time, though, I'd say there's been lots of people have come up with other factors that they thought would work that over that same period have fallen by the wayside and underperformed and potentially don't exist anymore. I think that this is a very good reminder that if you apply well understood factors over long periods of time, you can get a better result. You don't have to, but you can.
Sources and descriptions of data. Thanks for your time.
Okay, bye for now.